Okay. That number is getting to a good place, so it feels like a good time to make some opening remarks. Thank you, everybody, for joining first and foremost. We'll be talking about ESG and lower middle market private equity today, as the title would suggest. This is one of a series of webinars that Malk plans to be doing this year, so excited to have you all participating and hopeful to have you join for future editions. Some personal intros. My name is Griffin Hyde. I'm a vice president in Malk's private equity practice. I've been with the company for almost 6 years now. Really excited to be talking to you about ESG and how it applies specifically to lower middle market investors and particularly those that might be a little bit earlier in their journey. And I'm joined by my colleague Grant, who can introduce himself.
Yeah, of course. Thanks very much, Griffin. My name is Grant Stone. I'm a project manager in Malk's private equity practice. I've been serving our clients and corporates for about 3 years now, doing a range of due diligence, fund advisory, and other activities. It's a pleasure to be having this conversation with you today, hopefully to the benefit of everyone that's in attendance.
Well, thank you, Grant. A little bit of housekeeping. We're going to transition shortly to a recording, so you'll see us, but in different outfits. Recently recorded just to make it a smooth experience for everybody. That recording is about 36 minutes. So we'll hit play there. We'll watch alongside you. During that time, please feel free to enter any questions that you might have into the Q&A function that you'll see on the bottom of your screen. We'll gather those, we'll take note of those, and then at the end of the recording, we'll turn back to the live edition and we'll spend some time responding to those. If you have any questions that weren't addressed in the course for responses or that you'd rather take offline, you'll see our email addresses at the end of the presentation, and please feel free to reach out directly. The other note I'd offer is that you'll be receiving access to the recording after this conversation, as well as to the materials that we walk through. So should have access to this, in posterity, and hopefully that's helpful and valuable. I don't think I have too much else I wanted to take off before we got into it. So with that, I think we can transition to that recording and see you on the other side. All right. Well, hello, everybody. Thank you so much for joining. It's a pleasure to be speaking to you from the past. Excited to have this conversation today. The first of our webinars, February 2025, talking about ESG specifically in the lower middle market for private equity, with the focus on how to start, improve, and stand out. You have myself and Grant Stone speaking. I'm sure we've already given intros, but happy to click along here. Malk is an ESG advisor that's been in the market since 2009 with a focus on private markets investors and their portfolio companies. We started in private equity. That's our bread and butter, our background, why we feel well positioned to have this conversation today. Provide a number of services in that space, including due diligence, fund advisory, portfolio monitoring. I'm sure many of you will be familiar at this point. In terms of what we'd like to talk about and experiences that have positioned us to have that conversation, we serve both a wide variety of private equity investors. I think it's over 150 at this point, as well as, and especially through our new parent company, SLR, their portfolio companies and other businesses. I think that puts us in a unique position to understand, the challenges that ESG pose to both investors and to operators, and the opportunities that are available to those who do it well. In terms of what we plan to talk about today, you can see it broken down into these four basic parts. The first, of course, is why ESG matters, right? Why is it a good thing that you've registered? Why is it a good thing that you're interested in this space? What are the benefits one can hope to gain and to expect from doing ESG well and thoroughly? The next will be the ESG basics and how they fit into your ESG journey, right? What is appropriate for you in the lower middle market at this point in time? We'll make some assumptions maybe about where you'll be and where you'll be at in your journey, and we'll talk about what to do from that perspective. We'll, of course, talk about how Malk supports our clients who are on that journey and maybe at the places you are. And we'll end with a Q&A, which we'll send back to the live versions of ourselves. Hope to get your questions. Please feel free to submit them throughout the webinar. There will be a link for doing so, and we'll make sure to address those as time allows.
Thank you very much, Griffin. We can get started where you might expect us to get started, which is to define ESG. At the highest level, right, ESG stands for environmental, social, and governance. Those are topics, buckets. ESG is used as a term by the investment community to refer to considerations that fall into each of those buckets. These categories are obviously broad. When we identify, address, and try to improve ESG factors in investment processes, we distill ESG, this broad topic, into 12 key issue areas that you can see listed on the slide. So environmental considerations, with the E in ESG, for example, might include how climate change affects an investment or a business model, or how a business manages its relationship with waste, recycling, or its local environment. The social considerations, that S bucket, might involve how an organization addresses diversity, whereas a governance consideration, or that G, might include a business's approach to ensuring the privacy of sensitive information. So these operational issue areas relate materially to business success. The two spokes that Griffin and I will speak a little bit about in this presentation are risk mitigation and value creation. Those are our North Stars as Malk, but ESG also relates to the relationships between an organization, its people, and society at large. As you might imagine, coverage of these issue areas can be right-sized and custom fit, so it will vary based on the operations of a business. Product safety isn't a material concern for a services business or a business that doesn't make products, though several of the issue areas, namely climate change and diversity, are becoming table stakes for GPs and LPs, especially as the tracking of KPIs becomes more prevalent. And when we think about ESG, we think about ESG management, right? The purpose of knowing about ESG in the first place is to properly approach the good management of these factors and investment processes, both to meet investor expectations and reap other benefits. So ESG management, therefore, is how ESG considerations can be operationalized in the deal process, and how those considerations mentioned previously can both protect and create value. So those are the two spokes, right? Risk management, or value protection, which is that top row of boxes on screen, and value creation, which is the bottom row of boxes. The latter of which is slowly becoming more of a focus for investors who are generally advanced in ESG risk mitigation. Some examples are listed on the slide with respect to protecting value. ESG considerations can help investors and portfolio companies mitigate costs, like from incidents that might stem from poor ESG management. You might think of worker safety as an example of this. Environmental practices could lead to regulations and lawsuits, and all of that sort of risk mitigation bucket deals with poor ESG management across the environmental, social, and governance buckets. In terms of creating value, good stewardship can result in cost savings. Griffin's going to speak about this in a little bit, and how ESG relates to the balance sheet, but from a human capital perspective and from an environmental and a governance perspective, you can really create some value that can be captured later in the process. You can see with some of these figures listed on the right here that ESG is increasingly material to investors' considerations of performance and value creation. Surveys of private equity executives and deal makers more broadly are showing that stakeholder returns and margins can increase as a result of astute management, and more investors are starting to look at ESG as a way of creating value in that way. So with the knowledge that ESG management can be valuable, right? Like, where does it actually show up in the investment process? And the short answer is that ESG factors will be considered throughout the investment lifecycle from LOI to exit. ESG is first typically considered alongside the content that's covered by other material vendors in investment processes, right? A legal, a vendor that does HR benefits, or IT. That all happens in the due diligence process. Material risks or opportunities relating to ESG will be consolidated either internally or by a third party into an ESG due diligence report that can be leveraged for investment approval processes. Abridged versions of this process can also be conducted internally, like I mentioned, but the takeaway here generally is that ESG is considered when making the decision to invest. You'll see next that ESG also features in memos and similar deliverables for investment committees. So salient issues or opportunities relating to a target are considered by the IC before moving forward with an investment, and then the target obviously is added to the portfolio. As you sort of move down the line here, ESG management becomes a little more generative. ESG can be incorporated into value creation plans, or SOPs, that GPs have for their portfolio companies during the hold period, and the progress against the ESG factors, either identified in diligence or value creation planning, can be captured in year-over-year portfolio monitoring, whether it be KPI surveys, qualitative reports. ESG is a big, big part of how to increase value here. And these are critical to demonstrating appropriate ESG management in the hold period when you go to report out on some of the progress. Accordingly, we have listed that ESG content is often included in annual letters to LPs. We're increasingly requesting more information related to asset progress. Not listed here, the slide would have gotten a little more cluttered if we did, our public-facing annual reports, another format in which ESG content is packaged and communicated for the protection or acquisition of value. Also exit materials, right? Content demonstrating good ESG management in an asset is often included there as a means of capturing premiums when an asset is transitioned from one sponsor to another.
So Grant has spent some time talking about, ESG management and whether it's important to manage ESG, whether there are outcomes associated with managing ESG, and recognizing that I'm biased as an ESG advisor. I sometimes have a similar reaction to those in the industry who say, is it in fact important and should we be managing ESG, as to if somebody said, should we be managing revenue, right? Is it important to perform with respect to revenue? In my eyes, the answer is pretty similar. The answer is going to be yes for pretty much everybody. Whether it's the number one priority is going to differ for different businesses, right? To extend the revenue example, there are certain businesses for whom they're going to spend the next quarter, the next year, focusing on cost management more so. And the other distinction is that how one manages this topic is going to differ between companies. When it comes to revenue, there's organic and inorganic ways to achieve it, new customer acquisition, customer retention, and similarly with respect to ESG, there are a number of ways to manage and to prioritize. In order to kind of further this equivalency, one of the things that we've done is make clear that ESG does in fact show up in financial statements in the same way that revenue and other financial and operational characteristics do. So we're going to spend these few slides clicking through ways in which ESG shows up on the income statement and the balance sheet, respectively. So looking here at this list of ESG possibilities that are enabled and how they show up on the income statement, you can imagine a world in which ESG produces price premiums. Right? So, for example, if customers have a higher willingness to pay for a sustainable product, one that has lower emissions, lower waste, lower impact in various measures. When we move down this list, you'll see reduced energy consumption and reduced material waste, both of which can reduce cost of goods sold and OpEx, again, improving financial performance. Reduced insurance premiums, reduced cost of capital. You can see the flow-throughs, especially in the latter case, to interest expense. And there are tax credits, depending on your jurisdiction at the local, state, and federal level for certain ESG undertakings. I think some very classic examples include renewable energy credits, tax benefits for using electric vehicles, et cetera. These are dynamic landscapes, and I don't want to, forecast the extent to which these will be available for any given business. But I think it's important to make the point that ESG is not, in fact, intangible. ESG can be expressed in dollars in the same way that otherwise operational or brand-focused initiatives ultimately convert to dollars, and that's actually the motivation for doing them. If we click through talking about the balance sheet instead, increased capital resilience. I think this is a really good example when we think about climate change in particular, capital resilience being the ability to ensure that a business's assets are resilient to things like extreme weather events, right? Is this business and its facilities and its equipment positioned to stay standing after an extreme weather event passes through the area? For businesses that have more physical assets, this is going to be more of a risk as compared to those that are a little bit more intellectual property heavy, more remote work driven, et cetera. So, variably important for businesses, but one that does have, legitimate financial impacts. Increased capital value, right? Have you bought modernized equipment? Generally more recent and contemporary equipment is more energy efficient. And so to the extent that you're pursuing energy efficiency, you will also have relatively more valuable capital, which will show up either as a short-term or long-term asset. And then at the bottom here, when we're thinking about liabilities, A few examples include reduced insurance liabilities. I think Grant used the example of work health and safety before, to the extent that your premiums are lower because your historical performance is better, to the extent that your claims payouts are lower because of the recency and the severity of incidents, your insurance liabilities will go down, as will liabilities associated with regulatory fines and penalties to the similar extent that you're able to avoid incidents that yield the same. Hopefully, before clicking on, what you've learned from these few slides is that ESG can be converted to dollars, can be spoken about in the same ways that other initiatives and undertakings are, which is to say they affect the financial standing of the business as seen through these classic financial statements. And when we think about financial statements and again, sort of the implied standing of the business and all the impacts that we just talked about, those gross up to be not just a benefit for the business, but a benefit and advantage for investors as well. We have a few ways here to demonstrate the expected impact of positive performance and positive management of these topics. On the top, you'll see that for top quartile ESG performers relative to bottom quartile ESG performers, you can expect better EBITDA margins, better growth rates, better shareholder returns, and better returns on invested capital. So across the board by various measures, you will perform better, as will your portfolio companies. On the bottom, there's some interesting ties between exit valuation and specific topical performance areas, right? So for those that are performing better than median with respect to carbon emissions and waste and water usage and women-female promotion within an organization, as well as broader diversity on the board, how does that lead to, or at least correlate with, higher? And I think when we think about the causal mechanisms of increased exit valuation, what I'd call out is on the right in particular. There's a recent survey of M&A deal makers that said, what premium is your organization willing to pay for an asset with a high ESG profile, or at least one that improves your own ESG profile? And you'll see that 3 to 6% and 6% were two of the more common responses, right? Well over half of respondents expected 3% or more of a premium on the basis of positive ESG performance, which is, I think, a really important causal mechanism of that exit valuation boost, and the sort of premium that we'd expect many of you to be interested in, the sort of exit, that sort of outcome that we'd expect many of you to chase. And what we're trying to give you in the course of this conversation is a little bit of the playbook of how to do that.
Definitely, Griffin. I think this is an appropriate inflection point to start thinking about what peers are doing, right? So given all of that, how does the market consider ESG? What are the drivers there? And then we can start thinking about how GPs can stack themselves against others. Malk has a privileged position to understand how firms are stacking up. On a yearly basis, we issue a state of ESG survey to understand the market contours relating to LP demand and regulatory developments and GPs' development of programming more broadly. And while data collection for our 2024 State of ESG survey is ongoing and should be available before long, our 2023 State of ESG survey solicited feedback from a group of 48 general partners on their ESG programs, and we generated some useful insights. So we talked a little bit earlier about drivers for ESG adoption, and we confirmed some of those reasons directly from GPs for ESG program development. I think unsurprisingly, LP demand appears the biggest driver of program development across the board. Regulatory compliance and a desire to stay competitive with peers are also there. As for the program development itself, right, the actual programmatic elements that need to be stood up, we see a significant jump year over year in GPs with some standard controls that we'll talk a little bit about today. Over a 20% delta in respondents maintaining an ESG policy, which was almost universal among the survey set. Similarly, significant jumps exist for trainings and ESG committees that get stood up respectively. And on the right of the slide, you'll see a promising statistic about GP's approach to ESG as a result of economic or geopolitical factors from 2023, though obviously we'll be looking forward to future survey responses to monitor how things develop, especially with recent cultural and political developments. The other statistics suggest that a simple majority of GPs in the set include ESG and exit materials for assets being sold, right? And that, I think, is speaking to some of the content that we discussed earlier about capturing those premiums and exits.
recognizing that we've shown now what GPs are doing on average, we also want to be clear that GPs are going to take different approaches. Right? Not everybody's going to do the exact same thing. There's going to be a distribution of program types. I think one of the drivers is what type of ESG program, what type of ESG approach do you want to have? Do you want to be a market leader? Do you want to be a market taker? What is this as a priority relative to your other priorities? And what is this as a differentiator as compared to something that you're looking to check the box on? So one way that we communicate the distribution of ESG approaches is on this slide. The first being relatively lower maturity, minimum viable programming. This is that checkbox exercise. This is, I want to make sure that I do not get in trouble with my current LPs, with prospective LPs. I want to stay in compliance. I want to communicate what is being asked, but don't necessarily see this as something that I, as a firm or in my portfolio, am going to use to, differentiate, right? This is more focused on the risk mitigation side of the spectrum that Grant spoke about than it is in the value creation side. Naturally, the next step is intermediate, right? It's relatively better. You're not necessarily leading, but you're doing more than you strictly have to. For example, inclusive of monitoring, right? Are you going back to your portfolio companies after you've done that initial checkbox exercise and saying, how are you improving? You're looking at KPIs in order to do the same. And you're also participating in industry frameworks, right? There are many, many acronyms, many, many organizations that are trying to tell you how to do ESG or trying to create some sense of alignment on ESG. And participation against those is one of the easier ways to up-level your program, both with respect to the actual outcomes and impact and the ways in which it'll be perceived. And the last one is the advanced bucket, right? This is where you're looking to differentiate, you're looking to be market leader, to pursue top quartile performance. You're looking to focus on value creation, as we've talked about. And in this bucket, we'll expect to see relatively more implementation work with portfolio companies, right? We've identified this opportunity for improvement or for progress, and we're going to be there alongside you to make sure it happens, as well as annual reporting in order to drive accountability and even including impact beyond ESG. That is very different, right, than the previous two approaches. And the last thing I'll say before clicking through here is this is both meant to be a point in time question, what are currently my priorities, as well as a question of over time, right? Where do I want to go? What is going to be possible in a few years' time? How am I going to be different in a few years' time from what I am today? Most people, we recommend start with the minimum viable programming approach, right? If you don't do anything on ESG and it is day one, you should probably have some of the baseline elements, including policy, training, and diligence, which are listed here and which we'll talk about in a little bit more depth, be your focus areas. Once you've got your bases covered, then you can move into intermediate and start to broaden your scope. And once those are effectively implemented as well, you can think about whether you want to, whether you can, and how to become an advanced firm. So think about these again as both point in time questions and ones that inform your strategy over longer time horizons. I previewed that we'll talk in a little bit of depth about ESG policies, training, and due diligence. The reason is really from this slide, actually. This is a conversation for lower middle market private equity investors. I want to make sure that this conversation is adjusted accordingly, right? We'd be talking different topics if we were to speak with larger firms, relatively more mature ESG actors. We, through our experience with DDQs, through our experience with helping our clients fundraise, with helping them report on an annual basis to their LPs, have a pretty well market adjusted understanding, I should say, of what is expected of GPs at different fund sizes. For small and medium funds, defined as less than $1 billion in AUM and $1 to $10 billion in AUM, which we're going to consider lower middle market for today's purposes, you can see what the expectations look like. The baseline expectations, the things that really everybody should have are, again, policy, training, and due diligence, which we'll go into depth for those reasons. And as you become larger, the expectations increase as well, right? You'll start to see some of the deltas as you look from left to right. Medium funds, ones that have more resources, larger team, things like that, are expected to do more, including the industry frameworks and monitoring, which I've previewed. And when you look all the way to larger funds, things like greenhouse gas emissions, a full-time ESG professional, a public-facing ESG report as compared to an LP-facing report. Those become the expectations. But for the purposes of this presentation, we're going to talk about what it means to do what's expected of you, assuming that that is your day one priority for a relatively smaller and earlier stage firm.
Mhm. With that, right, what does it look like to get a program off the ground, right? What is that MVP, that minimum viable programming, to align with LP expectations for small funds? What does that look like? So we thought valuable to highlight those program components, the policy, the training, and the due diligence, what they might look like, what they might include, what function they serve, and what have you, right? So the first we can begin is an ESG policy. All of a GP's commitments and practices relating to ESG flow from an ESG or responsible investment policy. While there are GPs out there that have separate policies specific to more granular topics like climate change, the ESG policy is the most basic and foundational. You can see here listed are elements common to all ESG policies, right? We've done a number of these for our clients. There is sort of a common recipe, although every sort of stew doesn't look the same. There's always a recognition of ESG's value, right? And a commitment to some principles inspired by frameworks and standard setters. SASB aligned issue areas or issue area considerations, UNPRI signatory frameworks. There are different sort of standard setters out there that will inform sort of what exactly you reference. There's a designation of oversight typically. Who's responsible for ESG at the GP? This could be, a dedicated lead, or the responsibility for ESG can sit with people already in the firm. There's also a description of practices, right? How do we think about ESG investment? This is what we do. What are we actually committing to? How do we approach ESG and ownership? The policy is the document that has the answers to those questions, and this is something that's most commonly asked for by LPs. Other commitments typically include a review process that happens annually. This is a really dynamic space, and so the commitment to review a policy on a regular basis gives a GP some opportunity, some flexibility to position itself appropriately, especially, of course, in response to relevant cultural or political developments, some stuff that we're seeing currently.
Next on the list of must-haves for lower middle market investors is ESG training, right? We have this ESG policy which says this is what we as a firm are committed to our investors to doing. The ESG training is how you communicate those commitments rather than to your investors, to your team, right? The people who are going to have to integrate those commitments into their day-to-day activities, the people whom, their outputs, their decisions, their processes need to reflect ESG integration, especially on a look back basis, right? If LPs ask for evidence of integration, God forbid, regulators ask for evidence of integration, it is the work of these team members that has to reflect that reality. And ESG training is the most efficient, effective, and kind of early stage way of making sure that happens. Similar to Grain's point about the recipe, every training is going to look a little different because every program looks a little different. You're communicating slightly different expectations to your team. That said, more often than not, there's some pretty important pillars to hit. One is an ESG overview in a very similar way to how we started this presentation. There's some amount of education and upskilling that is expected for your team. We recognize that most individuals within a private equity firm are not themselves going to be ESG professionals and might not necessarily be all that proficient for that. And so it's an important box to get through. The next is sector or industry trends, right? Making it local, making it relevant, given your industries of focus, given the industries in which your portfolio companies operate. What are specific topics that you need to understand, right? Is climate change something that's especially relevant because your businesses are more physically asset intensive? Or if you're a software investor, are there fewer ways in which climate change is material and therefore it's not necessarily important to speak about at this level of resolution? So you're always adjusting for materiality, as is specific to your investment thesis and activities. Then communicating LP specific expectations and trends, right? As I said, a large part of the issue policy and the commitments that are listed there and that are communicated to your professionals in this training are driven by LPs. This is consistent with the survey findings that we communicated earlier. And so communicating that to your team can increase the stakes of the issue management and implementation, right? It makes them understand why they have to do it. One of the levers being not just value creation, not just value protection, but basic compliance, and in the future, fundraising, right? To the extent that you want to either get new allocations or to have those same investors reallocate, you're going to need to meet the expectations of those stakeholders. And then lastly, what are the actual steps, right? What are the processes? What are the controls? Is this, a firm where ESG diligence is either already implemented or a new practice that is being implemented? If so, communicating, when in the timeline that is done, what parties to engage, what the output is supposed to look like, how that is supposed to be implemented into other work streams. That is the sort of work that ESG, creates for non-ESG professionals, and so it's really important to lay out those steps in as clear, concise, and actionable way as possible. I call out diligence for a reason. That's the last of our spotlights that Graham will hit.
Yeah, certainly, Griffin. Thank you. I think, once the training happens and once the policy is laid out, where do we go from there, right? The last component of that minimum viable programming is the due diligence that we've talked a bit about to this point. Due diligence is Malk's bread and butter. This is what we were created to do. We have a really good idea of where DD sits in the programming stack and the sort of value that good due diligence can bring. It's really the first place where the rubber meets the road, so to speak. The ESG policy and training get everyone on the same page relating to ESG, but the due diligence process is where ESG really gets applied to the companies under acquisition. I can speak a little bit about Malk's process as an example, right? Our findings in diligence are calibrated to a materiality threshold that considers a company's industry and business model and operations, right? That custom fit approach that we've been speaking about to this point. It gives a full account of how the company's exposure to those specific risks across issue areas, those individual E, S, and G subjects could result in adverse impacts to the GP, right? The point of due diligence principally is to understand how a company's risk exposure connects to all of those operational issue areas and how to really keep your investment safe. We've done hundreds of due diligence processes across all industries at Malk. We've worked for GPs investing in the defense industry, in healthcare, in technology, industrials, you name it, right? And we provide some granular visibility into what the highest priorities are in a business from an ESG perspective, along with the confirmation that no red flags relating to ESG will exist as well, right? The peace of mind that comes from getting your information across a whole bunch of different due diligence processes and subject matters. The due diligence process results in recommendations that describe a target's lowest hanging fruit for risk mitigation and value creation, and those takeaways become the real foundation for how ESG gets addressed in the hold period. Monitoring, reporting, ESG value creation plans, right? The due diligence lays the foundation on the ground, right? It creates the roadmap, and what happens from there during the hold period is how you improve those processes and start working towards capturing a premium on ESG when you transition off the asset.
So hopefully we've made clear by now that, at least in our view, we have a pretty good sense of where ESG sits in the private equity process, within the private equity market, and of course, specifically within the lower middle market for private equity. Maybe unsurprisingly, we built out our capabilities to respond to that, right? We have a service suite that addresses both the minimum viable programming that we've gone through, ESG policy, ESG training, ESG due diligence, as well as many other steps. We have it broken down into the right, as you can see, firm strategy, ESG diligence, value creation planning, portfolio monitoring, consulting and implementation within the portfolio, exit prep, and broad firm reporting. I think this is an important moment to say, to the extent that you're interested in, the minimum processes and products that we've talked about. Because we can support, we'd love to support, and we'd love to have that conversation. And then for those that are maybe slightly more advanced and interested in activities that were less so the scope of today's conversation, just as happy to engage on those and talk about what we do and what we think the benefit and impact of those are. With that said, going to turn it back to the live audience for questions. Appreciate your time and looking forward to the discussion.
Thanks very much, everyone.
All right. Well, there that was. Thank you, everybody. Happy to reconnect with you live and to talk through some of the questions that were submitted through the Q&A. Very much appreciate those who did so and who engaged. Looks like we have a few to take through, so maybe we can start, Brent.
Definitely. I can open this up and see what we have here. The first one looks like a good one to address. It reads, how does Malk's approach to service delivery differ for lower middle market firms than big firms in general?
Yeah, I'll take this. I think something that came up in the course of the recording, even I really want to emphasize is right sized, right sized, right sized. Right. Every one of our services can be and is adjusted depending on the specific characteristics of the client that we're engaging. When we think about the lower middle market, there are a few ways in which they tend to differ, and therefore our services tend to differ. Right. Generally, less budget for these sorts of topics. And so that is going to, manifest in our ESG diligence. We're going to do, slightly lighter touch reports. We are going to make sure that that manifests in the actual recommendations we make with respect to policy development and revisions, right? The commitments that we think are appropriate for lower middle market investors are different than the commitments we're going to recommend for larger funds, right? I think we already mentioned that we don't think industry frameworks are necessarily a day one lower middle market activity, right? And so the alignment to those industry frameworks is going to be less forward in policies that we create for those partners. So I think the general directional answer is that it's going to be lighter touch. It's going to be lower burden in response to the fact that these firms tend to both be earlier in their journey and be generally lower resourced. And happy to actually give examples of that maybe in follow-on conversations to this webinar today. Okay, so we're going to mark that one as answered. Next up, we had a question come in that says, with respect to the three activities that we spotlighted, right? A policy, a training, and a diligence. What order should a firm take to approach the implementation of those activities? I might have cut out there briefly. Brandon, can you confirm whether you can see or hear me?
Yeah, I can see and hear you. Can you hear me as well?
Yeah, I'll just repeat that question then. Specifically, the question was, in what order should a firm approach the implementation of a policy, training, and diligence?
Great. That's a good question. And whoever posed it might have gotten it what I would consider most correct right off the bat, right? I think that maybe the optimal way of implementing a policy, training, and a diligence is by implementing a policy, then training, and then diligence. I think the reasons for that ordering are several. The policy gets everyone on the same page with respect to ESG and commitments. So to be able to enact a training or to conduct due diligence, you first have to codify that expectation in an ESG policy. I think the ESG policy is also great to take care of first because it can be the lowest lift and also because it is often the first thing that gets asked about when LPs are asking questions about a firm's ESG practices. So I think it's fitting for that to be first in the stack. Once those commitments are put into place, it's a natural next step to communicate what those commitments are to investment team members and others of the firm. That's why the ESG training is a natural next step there. And then from there, the ESG considerations can be operationalized in a due diligence context. And so I think for those reasons and for several others that maybe aren't best explained as explicitly, I think policy, training, and due diligence in that order is probably the best approach. I can jump back in here into the chat as we tick through. To what extent is generative AI changing the approach to screening and ESG risk?
Yeah, I'll field this. The simple, maybe lazy answer is that it is and it isn't. I think the ways in which it is affecting ESG screening and sort of the ability to review and conceptualize ESG risk is very similar to how it's affecting other work streams. It's making things more efficient, right? So whereas historically, the review of public information might have required having a whole slew of databases and sort of different sources that you were going to and engaging with. AI makes it so that you can enter, your query, your target, and get responses from many different sources, many different databases very quickly, right? So I think it's really helping to get access to information from very many sources quicker. I think that's one of the key ways in which it is affecting things. I think the ways in which it isn't is that for all of our conversations, right, around materiality adjustment, right, the extent to which a given incident or a given regulation, et cetera, matters to a business is specific to that business's operations, its geography, its scale, its business model, its plans, even, right? What are its plans for growth? And those are all, dimensions and axes of consideration that are really hard to control for when using AI, right? That requires a real human in the loop approach, which says not just that these, are relevant, but is able to scale exactly how relevant they are and how urgently they need to be either communicated or addressed. So we see it in our work, and I think we advise clients to view it as a tool, as a resource, but not one that replaces the work itself, just one that makes it more efficient. So hopefully that's helpful. Next question we're seeing here. So we talked a little bit about value creation, but in slightly abstract terms. And I think there's some interest, Grant, in an example tactically of what a value creation project would look like for a portfolio company.
Definitely. I can make reference to our friends at SLR. Malk recently underwent an acquisition and are now a part of SLR, a more global and technically oriented sustainability management organization. And so when you think about the example of value creation, it is something that's a little bit further down the line. Typically, it's not obviously something that was a subject of today's presentation, but a very intuitive example is decarbonization and energy efficiency work. A value creation project typically focuses on the operations of a portfolio company or the implementation of a recommendation or a value creation op that was identified in due diligence. And so often we'll have portfolio companies of our clients that are interested in actually the nitty gritty and the how to of doing some of the things that were identified in the due diligence process. Energy efficiency and decarb is a good example because it's a way of capturing value that we referenced earlier in today's presentation, right? Cost savings, energy efficiency, resilience of equipment. Those are actionable, independent variables that can be controlled. And so with some of the technical expertise that we have at our disposal with our friends at SLR, we've done a number of these case study projects and of course can provide examples or discuss more about how some of these value creation engagements go, separately or not in the webinar setting. So the last question here, can you give us your thoughts on the outlook on ESG under this new administration? Certainly a topic that we've seen discussion of, and Griffin, I can probably pass this one to you.
Yeah, maybe unsurprisingly, we've been thinking a lot about this ourselves. We have teams of people who have been reviewing a lot of the executive orders that have been coming out and trying to translate it, for implications to our work and to our clients. So definitely some thoughts here. I think again, I would distinguish my thoughts in two ways. One is there's real cultural and geopolitical movement against certain topics that have historically been important to the ESG conversation, right? So I think that the example that is most clear to us right now is diversity, right? The ways in which that is being walked back at the federal level has implications for the requirements, for example, for a federal contractor or for the funding available for people who look to prioritize this, such as the selection of minority-owned businesses and women-owned businesses as contractors and subcontractors. So a lot of ways in which there's real pushback and there are implications for businesses, right? The value to be created or the value to be protected translated to dollars might have changed and might frankly be lower than it was prior to some of these outcomes. I think the thing that I'm excited about in maybe a weird way is that I think really what it's doing is it's raising the materiality bar, right? We're not you're saying that ESG writ large or DEI writ large is done and is gone, but the expectation is going to be moving forward that you're doing this in a way that can be communicated in dollars, right? That you are actually demonstrating that these are the material topics, these are the material actions. We're going to do them on the basis of their impact to our business and its performance, rather than on the basis of broader cultural alignment or virtue signaling, if you will. It's making everybody reconsider, what is, again, right-sized, fit for purpose. And I think we're going to see a real up-leveling in terms of people's ability to identify, what is material and then implement the same. So the scope might shift over time, but I think it's shifting in the direction of more and more appropriate and impactful undertakings, which is something I'm personally excited to observe and to participate in.
As am I. I'm checking the question and answer here, and it's not looking like we have anything outstanding. Of course, if you have more questions for us, we're happy to answer those. You'll see our contact information sort of oscillating between the question slide on the screen alongside us. But Griffin, I think we might be in a good position to close out here.
Yeah, happy to give everybody some time back. Again, very appreciative of those people who are able to attend today and of those who take the time to view the recording afterwards. To reiterate, we will send access to this recording as well as the materials that we walk through. You can expect to see more webinars from Malk in the coming months, and so please stay on the lookout for that. If you have questions about any of the content that we addressed, please feel free to reach out to these email addresses, and any feedback on the webinars as well, right? Topics you want to see covered, ways in which you want to see the format change, please feel free to reach out in that spirit. With that said, thank you again, and I hope you all have a good rest of your day.